Hello, welcome back. Hope you're having a nice Sunday today. We're going to take a look at Norwegian Cruise Line Holdings, NCLH is the ticker symbol. I have talked in the past about Carnival Cruise, which is a stock that I own. And it's actually kind of smart to examine this kind of consumer cyclical stocks, especially after the pandemic happened, because a lot of them have been really beaten down. And you can potentially play this for a trade for the most part, for like a swing trade, in which you are looking to make some money out of this cycle, this internal cycle that has been created because of the pandemic. Now you will see here that this company has been kind of going better and better in the last month. But if we take a look at the last year, for example, you will see here that it actually used to be in a much better spot. It used to be at around 32 over here or 33, and its 1 year high has been 34, close to 34. However, now it's currently at 21.64, so there is potential upside here. And if we take a look at the 5 year chart, you will see how it was bust during the pandemic over here. It actually used to be near the 50s or 60s level back in many years ago. If you take a look at the max, you will see that we're actually currently below its IPO days, which is interesting. It used to be 24.79 over here back in 2013. So as you can understand, this one can be a potentially very interesting play for a reversal, pretty much. But let's take a look at the financials of the company, see what they are doing and whether it's an interesting addition to our portfolio here. Scary to see all these reds here, right? All of these tickers all of these marks are actually an X here. So let's take a look. The P ratio is actually going down because the company is obviously losing net income. Again, during this pandemic, you could kind of expect that. Now, because this is a cyclical company and because we're examining this one for a reversal pattern here, yes, these X's here do play a role, but they may not necessarily be a not buy situation. We have to examine what the company is doing financially and whether we can actually take up some risk in order to potentially make some money in the future. I have talked about this concept some time ago in previous videos, especially the video that I made for X, this is US Steel, or the video that I made about Royal Carnival Cruise. And the concept behind this is that you should potentially, if you are interested in trading, be willing to risk, let's say, $5 in order to make $15. So you should be willing to risk one to make three. If you are into trading, this is the concept. And so here you may have some risk, and you may want to take up on this risk and potentially make a little bit of money. But we will examine the company for a long-term hold as well. I'm going to talk about it as we go. So the price to free cash flow ratio here is negative. Again, you could kind of expect this too. It used to be high, but now it's negative again, I'm pretty sure because of the pandemic. We will examine the details in much more detail later. Outstanding shares, look at this one. They have been massively issuing shares here, diluting investors because they need the funds, I'm pretty sure. And you'll see that this started happening during the pandemic is when they started issuing shares. Now that's concerning, but I do understand it from the board because it's the cheap way to get extra funds, extra capital, because otherwise you'd have to get debt, and this can be a much more serious situation because debt has interest, and so this one is free pretty much, but it's not free for the investors because they get diluted. The free cash flow to total liabilities is negative because the free cash flow is negative, and all the growths that you see here are negative, including the 5-year total equity growth. The company has been absolutely hammered here. For how much they have been hammered, the stock price is still holding relatively well, I feel. 36% down because their financials look like they have been completely annihilated here. Look at this. All the returns or the margins have been destroyed. Let's take a little bit of a closer look. This is one where we really need to examine the income statement here and all the other statements. Because look at this, the company was making 5.3 billion back in 2017 and 18, 6 billion, 6.4. And if you go down, you will see that they were net income positive. And then the pandemic happened, and basically nobody's going on a cruise, and they are having insane losses here. Now, again, you understand the situation, and you may expect the situation to end at some point, and you'd be right to think about this one. And this is why it may be worthwhile to potentially get this for a swing trade. But we do want to examine that the company is solvent, that they can actually withstand some extra pressure in the next years if we're willing to play this for a short term or even a longer term trade here. You will see that the company's actual total equity has been going down, yet they still have some reasonable amount of equity here that they can use. And so, while it has been going down, it's still not in the negative, and that's probably because of the company actually issuing shares. So you'll see the additional paid-in capital here. They got a lot of extra money because of issuing shares here. And so, of course, I think this kind of equity is kind of reasonable for what the company has done and the pressure that they have had to withstand. Yet remember that they have actually really diluted investors, and that is definitely a concern. So the cash flow statement, again, look at this. The top line tells you what the net income is, massively underachieving here, but for a reason that we definitely know about, the virus. And the operating activities cash flow going down, of course, for the same reason. Now, this the investing activities are actually still negative, so the company is actually still investing. And in terms of financing, they had to get some debt, understandably. Lots of losses here because of the pandemic. Look at this, they had to get like 6.5 billion and 1.7 billion in terms of debt. So they do have some extra debt that they actually took here. And the free cash flow has been in the negative lately. Again, the past couple of years, the company has been losing money because of this. And I do want to kind of take a little bit of a quick look here and go back to examine the debt that the company has. We can just kind of quickly use our stock analysis chart here, and you will see, if you take a look here, the debt to equity ratio can be a very quick way to determine what kind of debt the company has, as well as the current ratio, because the debt to equity ratio, you can actually see here, we prefer it to be less than 1, because it shows the relationship between debt and equity. And so for every $6.7 of debt, we have $1 of equity, is what this means right now. So we have quite some debt that we need to be aware of. And this is something that actually increases our risk, understandably. The current ratio is 0.885, which we typically want to be more than 1 or 1.2, as you'll see here. And that's because this is current assets divided by current liabilities. And by current, we mean the 12-month ones, the short-term ones. So short-term assets divided by short-term liabilities. And so you can understand that we have more liabilities in the short term than assets, is what this actually tells us, if it's less than 1 or 1.2. So the company is in a little bit of a weird spot right now, but again, we do know why this is happening. And so what we can do is take a look at our stock evaluation tool and kind of use what the company was doing before the pandemic and project the results that this could potentially have after the pandemic. So this is what we're going to try now. And this will be on the premise that the pandemic will start dissipating, like the pandemic results will dissipate, and the whole thing will get back to normal. Because otherwise, we could be still seeing these kind of numbers and have extra risk as we have right now with this company. But yeah, you'll see that the revenue growth and margins here have been completely bust. We're not going to be taking too much, we're not going to be taking into account the 5-year average or the 3-year average too much, because again, they have been massively skewed because of the pandemic results. We're going to go back and see what the company was doing here in these 3 years. And so we're going to use, let's just say 6, 7, and 8 here, I think could make sense. Actually, I'm expecting more, to tell you the truth, because exiting the pandemic, the company will probably grow at its previous numbers. So in the next 5 years, I'm going to give it more. And this is sort of like an exercise to understand what kind of projections we can use here. Because the company went from 6.4 to 600 million. And so this means that they dropped down massively. And if things get back to normal, you could see them have explosive growth. So I'm going to use higher numbers here, 15, 20, and 25, because I expect those for the next 5 years, in order for the company to get to its previous growth, to its previous levels, pretty much, not even growth. So the net income margin is probably going to be at around this level. So I'm going to use, let's go use 12, 14, and 15 here. The free cash flow margin, yeah, let's just use here something like 60, 70, and 80, something in between. And the annual return that I want to be making is 13%. And let's see what these kind of projections will give us starting from 2021 and calculating for the next 5 years. So calculate here. And we see that we're getting much lower values here with these projected revenue growths. But again, you can understand this because we are starting from a point where the company is actually making 648 million in revenue, and we are projecting this kind of revenue growth and net income margin, which could be better in terms of revenue growth, at least for the next 5 years. So for the 25% one, which I think is very achievable for this company right now because of their current stance, you could actually even see 100%. It's very likely, because if you calculate that for the next 5 years, you're probably getting to a spot of around like 6 billion. It's probably going to be a little bit more, because 100% is going to give us 1.2 billion, then 2.4, then 4.6, and then like 9. And this is where we're kind of coming closer to this value. So I think that it's likely that the company in the next 5 years could even achieve like 60, 70, and 80. And again, you can see how following through this kind of exercise and how I'm thinking about this stock and how I'm thinking about this company, you can do all your projections yourself when you get your access to this tool. It's going to be in a few days or so. I'm releasing this tool for people. So remember to subscribe, by the way, to know when that happens. And you can actually see here that if I'm using these kind of values, like 60% could happen for this kind of company, again, because it has been super bust. This is a 5-year discounted free cash flow model, and if you calculate with this, then you are getting a much better value here, and you can understand that this may even be a buy here. So you can see how the revenue growth really skews this, of course, understandably, but we cannot typically use 60, 70, 80% on a company like Facebook, for example. It doesn't make sense, right? But it makes a lot of sense for this company, because their revenues have been like 90% down. And so when they have been 90% down because of an event like the pandemic, you could expect them to go up like 180% high in order to reach their previous levels. Because remember, when a company's stock, let's just say, falls from 100 to 50, it falls 50%. But in order to get from 50 to 100, it has to rise 100%. Yet the thing is, customers are there, and this is very likely to happen in the next few years, because this was a temporary event, it was a pandemic. And so when people actually go back to their previous habits, you could very well see this company rise back to its previous levels. So this is why I think these kinds of cyclical companies can be interesting purchases for somebody who is willing to take on some risk, because there is risk here. There is risk that the pandemic will continue for a while, and that the company will not have enough liquidity to continue and may even default. So if you are fine with these risks, and I personally am fine in some situations, and I'm willing to take a little bit of risk here, you can actually add some money and wait and see how it plays out, and maybe gain 3 times your money or 4 times your money if this goes back to normal. This is exactly what I did with American US Steel, when I bought it at about $8 or so, and I sold it at 25, near 25. So you can see how taking a little bit of risk, especially in a cyclical industry, or when a cyclical event happens and we're expected to go back to the previous levels, you can play this for a trade and take up some risk and take on some risk, and just wait and see how it plays out. Again, because of this kind of cyclical patterns. Hope you enjoyed the video. Please leave a like if you did, and remember to subscribe. If you did enjoy this one, take a look at the video that I made about Carnival Cruise, which is another very similar cruise line, and having a very similar pattern here. I actually own this one. So thank you for watching, and I'll see you soon. Bye bye.